How you feel? Uh-oh, the board's coming out.
Hey guys!
Hey guys.
So if you saw that little clip we just had for you, you'll know that I was pretty sick last week. And, you know, my amazing caregiver here was kind of busy helping me out, trying to make me feel better. So couldn't make a video last week, unfortunately. But we're back! You know, I'm not 100% better, but I'm at least at like a 75. I think that's good enough to, you know, start doing more videos. So
Definitely a lot better. We got through it, and we're ready today to talk about the stock market.
Oh my god!
Yeah.
Yeah.
The most fun topic ever. Would you agree?
And by fun, he means that sarcastically, which is why I have some props here. So, you know, just because I'm here for you guys, and, you know, I get it. It can be boring, and it could be complicated to understand.
But it can also be fun. It's fun.
We're going to try it. I'm going to make sure. So we have a question mark here, you know, in case we just don't understand anything or we have a question. And then a little ding button in case it gets boring and, you know, we need to liven it up a bit or fun it up a bit. So
ding.
Beware of, you know, seeing this whole thing a lot. So, yeah. Okay.
Should we get into it?
Yeah, I think so.
All right.
I think we're ready.
So, the stock market. Okay, so what is that thing? Like, do you have any, like, inkling or idea what that is?
I just know it has to do with the economy.
Okay.
And I've heard a lot when dealing with the stock market, buy low and sell high.
Okay.
That's it.
Both good things, and yes, those are true. But really what the stock market measures is kind of you can think of it as like the financial health of companies in the United States and even internationally, depending on what we're talking about. Okay. So the stock market, essentially when you own a stock in a company, what you're owning is a very, 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 very small piece of the company. So when I'm talking small, I mean like 1/1,000,000th or even more, like even smaller of the company.
That's not a lot.
So when you own a stock, technically you can say that you own part of that business that you own a stock in.
So speaking of, because I know someone loves to say that they own stock in companies. What companies do you own stock in?
Yeah, so like I have stock in Southwest Airlines. So it's good to fly on like the airlines that you own if you own airline stock, because it helps their business, and then it's like you're a fan of the company, which is really cool. And that's the really fun part about stocks that I sometimes think people don't get, is that you can not only like invest your money to grow it, which is the ultimate goal of, you know, why people usually invest in the stock market. It's like planting a seed, and then you hope it grows into a big, bountiful forest eventually.
So if you like money, you should be investing in the stock market.
Yeah, exactly. And it seems kind of hard, like a hard barrier to entry to get into, because there's all these terms and like things that financial money managers make it like really hard to understand. Like what is a mutual fund and what is this index and that and that. But we're gonna like really simplify it.
Okay,
really,
I was about to say, are you gonna explain that?
Yeah,
okay.
Most of them are very simple terms with more complex words to describe. So the way we measure the stock market is by using these various indexes. So one of them is called the Dow Jones Industrial Average. A lot of people have heard of that. Yeah, so Dow Jones, who is Dow? Dow was this guy from the 19th century who came up with this index that I'm not sure exactly like how it started, but what it is now is... Yes?
Ding.
Oh, so you're just like, okay, I get it. So you're like agreeing with me.
No.
Oh.
Ding is like, okay.
Oh, you're getting bored? Okay,
Yes.
okay. We'll skip Dow. In the 19th century. It's an old thing. That's all I'm trying to say. But anyway, today. So now it measures the top 30 companies in the country.
Okay.
Not necessarily. I think it's by like market cap or something. There's some measurement, but it's the top 30. Okay. It's not necessarily the greatest measurement. It's the most popular. It's the one that a lot of people have heard of, but it's not necessarily the best measurement. So to compensate for that, there's two other indexes. One of them is the S&P 500, which is the Standard & Poor 500. I know it sounds crazy complex, but all it is the top 500 companies by market cap. That's it.
Okay, so can you explain what a market cap is?
All right. So yeah, so a market cap is short for market capitalization. that's basically to really water down what a company is worth. So let's say you were an investor and you had $10 trillion. You had a lot of money, and you said, okay, you know what? Today I want to buy Apple.
Ooh.
Then you can make an offer to the people that own Apple and be like, okay, well, I'll give you like $100 for it.
That's
But
a lot of money.
obviously, they probably wouldn't take that because they're worth a lot more than that.
Yeah.
So how would you like bridge the gap? If you're at a low amount and they're at a high amount, well, how do we like figure out what the company is worth? Well, that's where market capitalization comes in. So basically, you kind of figure out how much a company can generate in the future and then what it's worth now, and you kind of come up with a final number, and that's what the market cap is. So for example, Apple's market cap is over $1 trillion. It's a lot of money. They're actually, I believe they were the first company to get a market cap of over $1 trillion, which is a lot. So basically, you could say that Apple is worth around $1 trillion if you wanted to buy it. So if you were like, I want to buy every share of Apple.
That's a lot of money.
Again, the stock is also called a share. So if you wanted to buy all whatever 100 or it's probably like 1 million or more stocks of Apple that you can buy if you wanted to, but that's what you have to pay for it. It's $1 trillion. So that's what market capitalization is.
Okay.
But going back to S&P 500, that's just a list of or an index of the top 500 companies. So that gives more of an accurate representation of like where these companies are like financially, essentially. And then that helps you kind of judge as an investor, because when you want to buy a stock, you have to think of it like you're an investor. Like the best way that I've heard that you should approach it is to look into a company like you're going to buy it. So even though you're not going to buy the whole thing, you are going to buy a little piece of it. So when you go to invest in a company, you don't just want to be like, oh, I like Tesla, I'm going to buy that. Or I like Disney, so I'm just going to buy that. No, it's great that you like those things and you can always use their products and stuff. But when you're investing, you kind of have to approach it a different way, and you have to be smart. Because the worst case scenario is you make $1 million and you work your whole life to make $1 million, and then you buy one company with your $1 million and hoping that it turns into $2 million or $3 million and you lose everything. So then you work all that hard time to lose it.
That's sad.
Yeah, exactly. So we don't want that. So we're not going to do that.
No.
We're going to be smart, and we're going to do it the right way.
Okay.
So the right way is to approach it like you want to buy it. So you have to look into their financials. You can find that on Yahoo Finance. Yahoo Finance is a great resource, great website. You can look at any balance sheet, any cash flow statement, and all that is basically like when you do your personal finances, you have how much money you spend and then how much money you make. You can do that on a weekly, monthly, or annual, whatever you want to do. Okay. But essentially that's what everything boils down to. So that's just that idea, just a little more complex because they have a lot more numbers and ways that money comes in, ways the money goes out, and like itemizes all that, so you know exactly what's going on. So we want to approach it like we're investors and like we want to buy the company. So like for example, when I own stock in Southwest and Google and in a couple of indexes. So when I went about like looking into their companies to see if I wanted to invest, I would look at their balance sheet. See, like Google has really, really great balance sheet, in my opinion, like one of the best. Because they have very low overhead for being as big of a company as they are. And they have a lot of free cash available. So they have a lot of money to spend, basically. So if they want to get into a different sector, then they have the money to do that. Because they have so much cash. So, so you want to approach it as if you want to buy it, and then if it makes sense for you, if you look at the numbers, there's all kinds of resources you can look at online. Just look at like valuation metrics, or I always like, there's different philosophies. One of my philosophies I like is the buy and hold. There's buy and hold, there's buy and sell, there's technical trading, there's they call it fundamental investing or something like that. I'm more of a fundamental investor.
So what does that mean?
So that basically means some people use computers to figure out, like using algorithms, what the best stock to buy is. And they like to buy it when it's low and sell it when it's high, like you were talking about earlier. Yeah. So the problem with that is the old rule in investing, and what you really have to be careful of, is even with technical trading like that, where you think it would be like very easy, like it's just numbers. Every time you buy and sell is, the more you buy and sell, the worse off your returns are going to be. And that's by the numbers. So
What is a return?
So return is like that $10 that you get.
Ah,
Yeah.
okay.
Yeah. So when you buy or stock for 10 and then sell for 20, that return is $10 because you got $10 out of it.
Okay.
So you get your money back and you get the $10.
Okay.
The more you buy, the more you lose, they say. It's really what it comes down to. The reason why that is because it's like gambling in a way, in my opinion. A lot of people would disagree with that, but I think you can get in a lot of trouble because the worst thing that can happen is that you do that and it works. Mm-hmm. So then you're like, oh, well, it's really easy to make money that because I'm just going to buy when something is really low and then sell it when it's high. Okay, that's really simple. Problem is, it doesn't always go up. That $10 that you buy in, if you keep doing it, maybe like the 5th time, let's say you make $50, and then let's say you bought a stock for $100 instead, and it goes 100, 110, 100, 110, so you're making $10 each time. But let's say one time it goes down to 40. Mm-hmm. So then you just lost all that money and a little more. So it only takes one bad trade to ruin a lot of good trades. And the more you buy and sell, the more likelihood you have to have that one bad trade. But having said that, there are people that do it. There's people that make a lot of money at it. It's something that you can do, but you just have to be really careful. So that's the main point.
So yes. What would you say is an example of a good trade?
The best trade, and I kind of follow, I like Warren Buffett and his partner Charlie Munger. They own Vanguard, which is basically is kind of like the S&P 500 and the Dow. They own they own a index, which is they own a bunch of companies. So he owns Dairy Queen and Coca-Cola and all kinds of stuff. A lot of banks. So he owns a lot of stock. Warren Buffett takes that, but to the extreme, where he's not buying like $100. He's buying $1 billion of it. So he has the cash to do that. So he's kind of that way to the super extreme, and that's why he's worth so much money that he's worth. He doesn't necessarily own one company. He owns a lot of companies, and he's just really done well with his investing. But anyway, the best trade you can make is to buy something when it's low and then sell it years down the line when it's 10 times what it was when you bought it.
Okay.
The reason why that's the best trade is because let's say you bought something for $10. This is an example. Obviously, you would want more than $10, but as an example, let's say you had $10 and you sold it for $100.
That'd be nice.
20 or 30 years from now. The reason why that's so good is because it's a tax advantage, because you don't have to pay taxes every time you buy and sell something. So most people don't know that when you buy a stock and then you sell it at a higher number, you have to pay that's called capital gains. So you have to pay that in tax. So you have to put that on your tax return. So let's say you got really lucky that you took a big gamble. You put $50,000 on a stock, and you made $100,000 on it. So that means the stock went from $50,000 to $150,000. So that means that difference, that $100,000, would be taxed at your capital gains rate, or I think it's in your tax bracket, or one of those. So that means you'd be paying a lot in taxes, which you still get something at the end of it, but not as much as you thought. And that really, really, really adds up over time, especially if you're doing a lot of trading. So what the best thing to do is to make one really good investment and never sell it. Warren Buffett always says the best investment you can make is one that you never have to sell because you're happy with it. And when you do buy, then if you really believe in it, then buy a lot of it. Buy whatever you think you can afford and whatever makes sense. And if you really feel good about it, be ready to buy it and hold it. Buy and hold is the best way to go. Ultimately, that's to me and that's my opinion. That's not like fact or anything, but to me that's the best way to do it. And things like the Dow and the S&P and there's also the Nasdaq. The Nasdaq we didn't really touch on, but that's more like tech stocks and internet stocks, and there's a little bit of like financial stocks and stuff in there too. But it's really known for those like tech stocks. That's an index that measures all those too. So an index is just a measurement of all those companies. Like instead of having just Apple or just Google, then it's like Google, Apple, Facebook, like all those together mashed into one. It's called an index. So the main point being, when you're investing, be very selective. Really, really, really do your homework. Really, really be careful with what you're doing. Make sure you know what you're doing. If you don't know, either ask somebody research it, look it up, do something to make sure that you know what you're doing.
Okay.
You can take courses too. Nowadays, you can take online courses. You can look at YouTube videos like this one, and there's plenty of ways to learn. That's the great part of today is that there's so many ways to learn, and it really will literally change your life if you can learn to do it.
Yeah.
And then once you do, you go for it, and then ideally you would hold it the rest of your life. Like the stocks that I have, I want to hold forever. And if they go down, then I just want to buy more because that means they're going to be worth that much more in the future, I think. So, yeah, to me, that's the best philosophy you can have in investing in the stock market and growing that money you've worked so hard for and growing it to be something that's a blessing to you.
Yeah.
And that's ultimately what everybody wants. So.
And what's even great about that is as an actor, like, it's not the easiest when you're trying to work on just gigs and not or gigs and side jobs to get a decent amount of money where you're not working from paycheck to paycheck. So I feel like for investing, like, it can only help you if you're doing it smart. If
Exactly.
you're not, just being like, I'm just going to throw some money in the stock market today. Like, if you're smart about it and, you hold it for a long time, I feel like that'll only benefit you in the future. And, when you do get those nice checks, it'll help you even more so that way you have a nice little, bit of cash when you need it.
Yeah.
So.
Like I always say, when you take care of your money, it'll take care of you.
Yeah.
If you can just take care of your finances and be smart investing, it'll give you time to, for you to do your auditions, do your shooting, and it's just opens you. It's freedom. It's literally freedom, and that's why I love just learning about finances. And I think that's something that can really change your life. Gives you that freedom. So.
And who doesn't love that? Okay, so what has the stock market been doing lately, especially with the pandemic going on and everything?
Right.
Businesses
so that was a huge thing, especially in March when everything happened. The market was doing some crazy stuff that we haven't seen in a long time. So it was going up 2,000 points, which is a lot, and going down 2,000 points. On a normal day, it might go up a couple hundred, even maybe 300 or 400 on a really up day or really down day. But it was going up 2,000 points, and even above that. So it was going way up and down, and then eventually it went way down. I think March 23rd was the lowest it got to. So for example, using that Dow Jones index, right now the Dow is at 29,000 points. It's 29,400. Yeah, it's pretty good. It's close to an all-time high, and it's gone up steadily over the decades, but especially since 2013, 12, right after the 2008 crisis, it's been going up steadily, and now it's close to an all-time high. So that's why it's important to keep track of it, because if an opportunity like that happens again, then you're ready. But again, you just want to be smart. But so right now, mentioned, the Dow is at 29,400, the S&P is at 3,400, and the Nasdaq's at 11,800, which is pretty good numbers. Those are close to all-time highs for those indexes.
That's good.
Or the Nasdaq is at an all-time high, and I'm pretty sure the S&P is close to it, if not at an all-time high. So the reason why the Nasdaq is so high is because those are more tech stocks, and right now the tech stocks are booming because everybody's home and doing stuff from their house. So tech stocks are really big right now, so yeah, those are kind of metrics that people use and that you can use to see kind of what's going on. It's an easy way to keep track. It takes 2 seconds if you want to look. I use CNBC, or you can use Yahoo Finance. Just go on there and be oh, looks like the Dow's up 400 points today.
And what's nice about it, especially if you're like me, which half those numbers is wet, it'll be green if it's up and red if it's down. So it's super easy.
Yeah, try and streamline it. Green means good, red means bad, but it's not necessarily for your portfolio. It's called a portfolio, what you have, what you own. Because it could be individualistic, just depends on what you're in.
Yeah.
But it just gives you a general overview. If you know that the Dow is down 2,000 points, you know it's probably not good for your portfolio no matter what. So it's good to just keep track of it. Even if you just own a little bit, it's just good to monitor that, just to see where everything's at. So yeah, that's where it is now. Where it could go in the future, nobody really knows. Nobody ever knows. If anybody ever tells you that they know where the stock market is going, they don't, and don't listen to them. Because nobody knows. Nobody ever knows if they did know, they would be trillionaires by now. So that's not gonna happen. So I am in a lot of like broad index funds, they're called. So there are funds that you can invest in things like the S&P 500, and there's a total index fund, which is pretty good. It's good for investors who kind of like just want to get it and then not worry about it. You don't need to actively buy it, sell it, watch it. You just buy it, and over time, the stock market always goes up over time. I don't know. I know in the last 50 years it's gone up like 12%. So just to give you an example, like if I invested at 5% right now, and let's say you invest $6,000 a year for 40 years, then that's approximately like $240,000 over 4 years. Now that $240,000 at 5% would turn into $750,000. So that's 3 times return, and that's only for 5%.
Wow.
If the average for like the past 20 years has been, the past 20 has been 12%, and the past 50 has been like 10%. So let's just say even a little bit under that. Then let's say you got 8%. At 8%, you would be close to $1 million with your $240,000, and with 10%, you'd be at like $3 million. So that is the power of compound interest.
And I would trust him with these numbers because he has done all the math. So
yeah, it sounds complicated, but it's really not.
Yeah.
If you just buy if you just said I have no idea what I'm doing, my advice for anybody would be to look into an index fund. Give companies like Vanguard, Fidelity, or whatever like company you feel comfortable with. Obviously, make sure that you're comfortable with them and you know what you're getting into always. But look into that. Just buy an index fund, just to ride every company. The best thing you can do. The best investor, believe it or not, the investor that beats 95% of other investors, the professionals, the yada yada, the investor that beats all those is the one that puts $1,000 in their account and then forgets that they have it in there. And then they look 40 years later and they're like, oh, that $1,000 turned into like $100,000.
that would be
I
nice.
promise you that would beat 95% of any portfolio manager or anybody. That's why buy and hold is the best. So that's what I recommend. That's what I plan on doing.
I'd listen to him.
And
I have listened to him.
Look into it, and we'll make more videos that are more specific to
Yeah.
exactly the kinds of things you can do.
But of course, in the meantime, if you do have any questions, please comment, and we will make sure we try and answer them as best as we possibly can.
Hey, we're here to help.
Yeah.
That's the main name of the game right now.
Yeah.
Just help as many people as we can, and that helps us learn too.
Yeah.
So, and we plan on providing all that, getting super specific as we need to, or being a little more generic, or like making it easy to understand.
Yeah.
So yeah. This one we just kind of wanted it to be like a general, broad overview, and just to give you guys an idea.
Just to get your toes dipped
dip the toe in the water. Yeah. So.
So, given that, life is busy and, we have stuff to do in our normal lives other than this, as much as, hanging out with you guys is great. I think we're gonna, for now, just do videos every other week. So, stay tuned for that. Of course, subscribe, because that's the best way you can do that. Yeah. But, just make sure you like, comment, and subscribe as usual. Yeah. But also, just stay tuned, and we'll hopefully have some more fun stuff for you in the future.
Yeah, so, exactly.
Yeah.
Like and subscribe below.
Yes.
Sonic says hi, by the way.
Yes. Frickin' Sonic.
Yeah.
Yeah. Okay. Bye. Bye.